PhillipCapital Weekly Market Watch. I am Lin Sin from Unit Trust Research. Today, we are going to look into Asia economy as a whole and where is Asia heading to as US ends its ultra-loose monetary policy. As the world's largest economy gains momentum, with indicators unanimously pointing to a gradual recovery, the beginning of the end to US mammoth bond purchasing has become more vivid than ever. Across Asia, economies have been flooded with cheap money to fuel spending, sparking a surge in asset prices and inflation, as well as leading to a massive credit bubble. Markets worry that, with tables turned and dollars strengthening, the tapering of QE might spark some more serious and lasting trouble than a one-off panic. Growth in Asia's trade-dependent economies subdued. Asian currencies and stock markets tumbled as capital fled from the region and back to the perceived safety of rich world assets. Countries with huge current account deficit and heavily burdened by foreign debt came into the limelight as investors are concerned on how these countries fund their financial obligations going forward. India, already suffering with the trinity of fiscal deficit, slowing growth, and an unstable currency, the nearly 1.35 trillion rupees worth food security bill is highly likely to exacerbate the government's weak finances. The value of the rupee has fallen almost 20% against the greenback this year, marking new all-time lows. Meanwhile, Indonesia, following India's footsteps, has raised the benchmark interest rate to defend its falling currency, which has been pushed down sharply to more than 4 years lows. Indonesia's foreign exchange reserves have shrunk by 20% in the past 2 years. Malaysia's outlook was downgraded by international ratings agencies, Fitch Ratings, from stable to negative, amid growing concerns about government debt levels, which is over 68%, exceeding the 55% debt ceiling, if government guaranteed debt is included. Further to that, the country's current account surplus has narrowed by 1/3 from a year earlier in the second quarter, weighing on ringgit, which was recently set a new 3-year low. Prime Minister Najib Razak, who is also the finance minister, is expected to address Malaysia's fiscal position in the upcoming 2014 national budget. Prior to that, Malaysian government has deployed its first measure to tighten fiscal policy by cutting fuel subsidies, which will drive up inflation in due course. Thailand has slipped into a mild recession in the second quarter, while political turmoil on proposed amnesty bill deferred the 2.2 trillion baht infrastructure projects. The nation's current account deficit widened to $709 million in July, while grappling with faltering exports and slowed foreign investment. Household debt to GDP has risen from 55% in 2009 to almost 80% today, while total debt to GDP now stands at 180% according to data compiled by HSBC. Nevertheless, countries have painfully learned from the past crisis. Though it might seem to be alarmingly similar, much has changed in the past 15 years and it is a different picture now. Most of the Asian nations maintain a floating exchange rate policies. Even China has recently discontinued their fixed exchange rate in July 2005. Stock of foreign reserves and US Treasury bonds are built up as a hedge against speculative attacks, and credit cycles are proactively managed by policymakers. Hence, a repeat of the 1997 currency crisis and contagion is more unlikely. The economic fundamentals of the region have also strengthened by focusing on total factor productivity growth to drive production rather than capital investment. Improved sentiments, bright prospects on US and Eurozone rebounding, and a weaker currency will give a bigger boost to global growth and Asia's exports imminently. So while Asia is less likely to repeat the past, this does not mean fresh trauma is impossible. Asia may be in for a choppy ride ahead as US eases out of QE, and some countries might be hit harder than others. Nonetheless, we are still cautiously optimistic on the region. China, the main growth engine in Asia, decided to bite the bullet and pushed for financial reform at the cost of slower growth. Against this background, growth momentum accelerated for the second straight month in August, with PMI rose to 51 from 50.3 in July, marking highest in this year. This also indicates that the Chinese manufacturing activity has started to stabilize on the back of a modest rebound of new orders and output. Singapore has posted to be resilient against the regional slowdown with its strong currency. The country upgraded its 2013 GDP forecast to 2.5 to 3.5 with expectation that externally oriented sectors like manufacturing and transportation and storage on the back to support growth, with domestically oriented sectors such as construction and business services to remain resilient. Philippines, South Korea, and Taiwan have strong current account position and are unlikely to be dragged down. The Philippines is on an edge with its current account surplus and lower reliance on commodity export, making it resilient to the challenges posed at its emerging Asian peers. With the lower inflation and strong growth, the nation have ample headroom to maneuver policy. Thank you for watching this week's market commentary. We will see you next week.